This is why Eli Lilly stock might go up next week. Because on the last trading day, we detected unusual trades that expire in a week that represents the trades of wealthy investors or potential insiders who have access to more information and research than many of us do to make better financial decisions. And that is why the rich get richer. So in this video, we will analyze this unusual option activity to find out how these wealthy investors are trading Eli Lilly stock for this coming week. Without further ado, let's dive into the data and then show you how we are trading Eli Lilly based on this data. Now, when we take a look at the options time and sales tape, you actually cannot see the trades showing up. It actually doesn't seem like there's anything quite significant because you can see the quantities are just around 200 here. But our system was able to pick up more data. And you can see that on the August 16 options, that at the 900 strike calls, there was actually 9,080 contracts being traded. And they were opening trades because we can see that the open interest was just 2,960, much less. And so based on this data, we believe they were buying these 900 strike calls. And when they buy these 900 strike calls and you analyze this trade, you can see here on the risk profile profit loss graph, the share price on the x-axis. As the share price goes up, these call options become more positive. That is a profit. If it goes down, it is a negative loss because this is a bullish long trade. As we can see here, by confirming with the Greeks, the delta is positive. If it was a short bearish position, it would be a negative delta. Now keep in mind the risk with this trade. You can see here the theta decay of negative 143. So these options are very high risk. And we traded a separate strategy that has lower risk. And you can see our strategy here. At the 905 strike calls for each of our trades, we sold 2 of them. And then we bought the 910 strike call and the 895 strike calls. And so when we analyze our strategy, you can see here that each of our trades only cost $225 of debit. So we position size to manage our risk depending on how much risk we want to take. Because you can see that the risk is 225 is how much we put in because we could potentially lose 100% everything. The blue line is a negative 225 if Eli Lilly goes down and stays down. If it goes up, you can actually see our max profit on the blue line, which shows up over here on this box, what our max profit is. And that shows up at about $768 of profit per trade. So 768 is the max profit. That's the reward divided by the risk of 225. That means our risk to reward ratio is a 1 to 3.4, meaning we could potentially make 341% profit on this trade. So that is why we entered this trade and use position sizing to manage our risk. Let us know what you think will happen to Eli Lilly for next week. And keep in mind, this is a higher risk trade. It does expire in a week, and we could potentially lose 100%. But that is why we put most of our capital to stocks that wealthy investors are trading that have lower risk and a higher probability of profit. If you want access to those, we'll put a link at the top here where we share those trades on our website, and also strategies such as this one to reduce our risk in order to increase our chance of profit. Because not all trades will be profitable. Even this one might be a loss. But as long as we diversify with higher quality stock picks based on this type of data analysis, then we can become more profitable in the long term. As usual, please smash the like button, subscribe if you haven't. Take care and have a great weekend.